Assalamu alaikum. My name is Atifullah Khan and I am student of lateral BBA 4th. Today I have a presentation on principle of accounting. In this presentation we have three chapters. So today I will present you on these three chapters. Chapter number 1, we have accounting for decision making. Uh, the first chapter is devoted to an introduction to terms and techniques that are used in the remaining chapters. Many of the key chapters are introduced here that are used in the remaining chapters of the book. The accounting process. In accounting process, we have accounting links decisions makers with economic activities and with the results of their decisions. In accounting process, we have accounting information, decision makers, and economic activities. Accounting links decision makers with economic activities and with the results of their decisions. Our first task as accountants is to identify those economic events that may be recorded in the accounting system. Once we have accumulated the necessary economic information in a readable format, decision makers use the information to improve the decision making process. Decisions made will impact future economic activities which will find their way into the data accumulation process. Types of accounting information. Broadly speaking, accounting information can be placed into one of the three categories. Number one is financial, number two is tax, and the third one is managerial. In financial, the first financial accounting information that is primarily used by external parties. Tax information is used to help organizations complete obligations to report to the Internal Revenue Service and other regulatory agencies. In managerial accounting information, it is used by persons within the organization to help manage and control business processes. Financial information provided. Information users of financial information. The main are investors, creditors, managers, owners, customers, employees, regulators, IRS, EPA. The financial information provided, profitability, financial position, cash flows. These are the main users of financial information. Decisions supported, performance evaluation, stock investments, labor relations, resource allocations, lending decisions, and borrowing. Investors, creditors, owners, customers, and regulatory agencies are external users of financial information. Managers of a business operations are internal users of accounting information. Both external and internal users are interested in the profitability, financial position, and cash flows of the entity. Profitability is often measured on the income statement prepared for the company. The statement of financial position, also known as the balance sheet, reports the financial position of the company at any point in time. The statement of cash flows reports the cash flows, cash inflows, and outflows during a period of time. The examination of the financial statements of a company leads to decisions about the economic viability of the company. This assessment may impact the company's ability to raise money in the capital markets or negotiate with labor unions. Basic functions of an accounting system. Interpret and record business transactions. The first step in the accounting process is to identify and record business transactions. Often, the identification of economic events that can be recorded by accountants is a difficult process. Classify similar transactions into useful reports. After the economic information is gathered and recorded, we must classify similar transactions so they appear on the proper financial reports. We will spend a significant amount of time mastering the preparation of the basic financial statements. Here are summarize and communicate information to decision makers. Once the information is seen properly grouped, the result may be communicated to users of the information. If the information is to have meaning, it must impact the decisions of an informed user. External users of accounting information. These are owners, creditors, labor unions, governmental agencies, suppliers, customers, trade associations, general public. Provide information useful in making investment and credit decisions. Provide information about economic resources, claims to resources, and changes in resources and claims. Provide information useful in assessing amount, timing, and uncertainty of future cash flows. Provide information useful in investment and credit decisions that are specific. Objectives of financial reporting. The objectives of financial reporting go from the general objective to the specific. The most general objective is to provide information useful in making decision about investments and credit decisions. A more specific objection is to provide information that is useful in assessing the amount, timing, and uncertainty of future cash flows. Without positive future cash flows, a company cannot sustain operations. The most specific objective is to provide information about resources, claim against those resources, and changes in the balance of resources and claims. Objectives of external financial reporting. Balance sheet, statement of cash flows, the primary financial statements. There are three basic financial statements that we will study in this course. These three include the balance sheet, income statement, and statement of cash flows. The balance sheet is often referred to as the statement of financial position because it shows the resources of a business and the claims against those resources. The income statement is often referred to a statement of operations. This financial statement measures the revenues earned by a company during a period of time and the expenses incurred to generate those revenues. The statement of cash flows provides information about where the company got its cash, where it spent its cash during a period of time. Characteristics of externally reported information. This means to an end, usefulness enhanced by explanation broader than financial statements, based on general purpose assumption. Historical in nature, results from innate and approximate measures. Users of internal accounting information are Board of Directors, Chief Executive Officer, called as CEO, Chief Financial Officer, CFO, Vice Presidents, Business Unit Managers, Plant Managers, Store Managers, and Line Supervisors. Objectives of Management Accounting Information. To help achieve goals and missions are the primary accounting objective about management information. To help evaluate and reward decision makers. Unlike financial accounting information, managerial accounting information is developed to help managers achieve the goals and missions of the organization. The information can be used to evaluate the performance of managers who are responsible for decisions about directing and controlling resources. Characteristics of management accounting information is timeliness, identify decision maker, a means to an end, measures of efficiency and effectiveness, and oriented towards future. Integrity of accounting information. Institutional features. Generally accepted accounting principles as GAAP, Financial Accounting Standards Board, Securities and Exchange Commission, internal control structure, audits, and legislation. The Financial Accounting Standard Board is recognized as the group in the private sector that makes specific accounting principles. If an accountant departs from the principles established by the FASB, proper disclosure of the departure must be made. In the public sector, the Securities and Exchange Commission has the authority to establish accounting principles for companies reporting to the agency. Currently, the Securities and Exchange Commission has accepted all pronouncements of the FASB for use by reporting companies. Integrity of accounting information. Professional organizations are American Institute of Certified Public Accountants. Second one is Institute of Management Accountants, Institute of Internal Auditors, and American Accounting Association. One of the most influential professional organizations in the accounting is the American Institute of Certified Public Accountants, or AICPA, pronounced as. It represents the interests of CPAS, the Institute of Management Accountants, or IMA, and the Institute of Internal Auditors, or IIA, represent the interests of accountants and auditors working with an organization. The American Accounting Association is composed of members from academic. Your accounting instructor is probably a member of the American Accounting Association. Competence, judgment, and ethical behavior. Certified Public Accountants, Certificate in Management Accounting, Certificate in Internal Auditing, Code of Professional Conduct, and CPA. Ethical behavior is the cornerstone of the accounting profession. Recently, we have seen many corporate scandals involving individuals who acted in an unethical and oftentimes illegally way. Ethics is the belief system that permits us to distinguish right from wrong. It is something that develops over our lifetimes and serves to help us identify good and bad behavior. Professional organizations have promulgated codes of ethics that must be followed by members of that organization. Careers in accounting. Public accounting, management accounting, governmental accounting, and education accounting. Careers in accounting can follow many paths. There is great demand for financial accountants in the preparation of financial statements, dealing with regulatory agencies like the Internal Revenue Service, and consulting. Management accountants help track product cost, prepare budgets, and serve as a consultant to managers. The field of taxation includes everything from the preparation of tax returns to consulting with clients about estate and gift planning. Here we are done with chapter 1. Now we are coming at chapter 2, and chapter 2 is about basic financial statements. So we move on and start with introduction to financial statements. What is financial statement? Financial statement is a structured representation of the financial position, also known as balance sheet. Financial performance are income statement of an entity and the inflow and outflow of cash, also known as cash flow statement. The objective of financial statements is to provide information about the financial position of the company, financial performance, and cash flows of an entity. Financial statement is also help to assess the probability that an enterprise will be able to make future cash flows. The basic financial statements are balance sheet, income statement, and statement of cash flows. Balance sheet describes where the enterprise stands at a specific date. Income statement depicts the revenue and expenses for a designated period of time. Statement of cash flows depicts the way cash has changed during a designated period of time. These financial statements are windows to a company's performance and health. What is balance sheet? The balance sheet represents a record of a company's assets, liabilities, and equity at a particular point in time. Balance sheet is named by the fact that a business's financial structure balances in the following manner. Here we have accounting equation assets is equal to liabilities plus shareholders equity. Asset represents the resources that the business owns or controls at a given point in time. This includes items such as cash, inventory, machinery, buildings, etc. The other side of the equation represents the total value of the financing the company has used to acquire those assets. Liabilities represent debt, while equity represents the total value of money that the owners have contributed to the business, including retained earnings, which is the profit made in previous years. The balance sheet and the accounting equation. We have assets, liabilities, and equity. As assets is equal to liability plus equity. In asset, we have cash, inventory, land or buildings, equipments, accounts receivable, and securities. In liabilities, we have accounts payable, wages payable, tax payable, notes payable, short-term loan, long-term loans. In equity, we have preference stock, common stock, and retained earnings. Why do we need balance sheet? We need balance sheet because it provides investors with a snapshot of a company's health of the debt provided on the financial statement. If a company assets are large relative to liabilities, it is in good shape. Conversely, if a company with a large amount of liabilities relative to assets has risk to creditors, the higher the debt ratio, the greater risk will be associated with the firm's operation. In addition, high debt to assets ratio may indicate low borrowing capacity of a firm, which in turn will lower the firm's financial flexibility. What is income statement? The income statement shows an information about the revenues, expenses, and profit that was generated as a result of the business operations for that period, and it measures a company's performance or a specific time frame. The components of income statement are revenue, mean how much the company earned. Expenses mean how much the company has spent. And net income before and after tax mean the profits of the company. Why do we need an income statement? Because income statement answers the question how well is the company business? Does is performing well? Basically, the question is it making money? Firms will Firms with low expenses and higher profits relative to revenues are typically more desirable for investment because it brings more money directly to a shareholder. The statement of cash flows. A statement of cash flows represents a record of a business cash inflows and outflows over a period of time. It is the most sensitive statement and it focuses on the following cash related activities. Number 1, operating activities. 2, cash flow, cash from investing. 3rd, cash from financing. Operating cash flow, cash generated from day-to-day business operations. Cash from investing, cash used for investing in assets as well as the proceeds from the sale of other businesses, equipment, or long term assets, cash from financing, cash paid or received from the issuing and borrowing of funds. Statement of cash flows is very important to investors because it shows how much actual cash a company has generated. It shows the ability of firms to generate cash. Many companies have shown profits on the income statement but struggle later because of insufficient cash flows. Because the income statement includes non cash revenues or expenses, which the statement of cash flows excludes. It shows correct figures of firms because cash flow statement is very difficult for a business to manipulate its cash situation. Earnings can be manipulated, but it is tough to fake cash in the bank. For this reason, some investors use the cash flow statement as a more conservative measure of a company's performance. Bringing the financial statements all together. The three financial statements, which are balance sheet, income statement, and cash flow statement, are all related. The changes of assets and liabilities that is indicated on the balance sheet are also reflected in the revenues and expenses which are stated on the income statement, which shows the company's gains and losses. Cash flows provide more information about cash assets listed on a balance sheet and are related, but not equivalent to net income shown on the income statement. Therefore, no one financial statement tells the complete story of firms. Accounting principle. Certain accounting principles that are important for an understanding of financial statements and how professional judgment by accountants may affect the application of those principles are shown in the next slides. The concepts of business entity. A business entity is separated from the personal affairs of its owner. We have basic asset valuation uh, accounting principles. The number one is cost principle, second going concern assumption, third objectivity principle, stable dollar assumption. The cost principle asset evaluation defines about the cost principle, which tells us that accounting information is based upon actual cost incurred. We refer to this as historical cost. The going concern assumption states the business entity is assumed to continue operations in the future. In objectivity principle asset valuation uh, accounting principle, the objectivity principle states that accounting information must be unbiased and based upon independent evidence. Stable dollar assumption. The stable dollar assumption tells us that we will only record accounting information that can be expressed in monetary units, usually dollars in the United States, and the dollar will remain constant across fiscal periods. Statement of financial position. Here we have the format of financial positions. We have financial position of ABC company, also known as the balance sheet of January 1, 2007. On one side we have cash, on the other we have liabilities and owner equity. In asset we have cash, notes receivable, accounts receivable, supplies, land, building, and office equipment. This has total of $300,000. On the other side, we have liabilities and owner's equity. In liabilities, we have notes payable of $41,000, accounts payable, salaries payable. The total is $80,000. In owner's equity, we have capital stock of 150,000 and retained earnings of 70,000. So all total comes equal. The assets is equal to liabilities plus owner's equity. Business transactions affect the elements of the accounting equation. We have accounting equation of assets is equal to liabilities plus owner's equity. In coming, we demonstrate how certain business transactions affect the elements of the accounting equation. Let's analyze some transactions for Abiba's Care Service Company. On May 1, Abiba and her family invested $8,000 in her care service company and received 800 shares of stock. So we have Abiba Care Service Company balance sheet of May 1, 2007. We have asset of cash 8,000 and owner equity of capital stock $8,000. On May 2, Abibas purchased an office equipment for $2,500 cash. To explain how the statement of financial position, often referred to as the balance sheet, is an expansion of the basic accounting equation. The cash side of assets, these transactions impact the statement of cash flows. The other side of accounting equation of owner's equity, the retained earnings balance transactions impact the income statement. Let's prepare the income statement and statement of cash flows for Abiba's Care Service Company for the month ending May 31, 2007. To explain how the income statement reports an enterprise financial performance for a period of time in terms of the relationship of revenues and expenses. Aviva's Care Service income statement for the month ended May 31st, 2007. Here we have sales revenue of $750, operating expenses or gasoline expense of $50. We have net income of $700. Investments by and payments to the owners are not included on the income statement. Abiba's Care Service statement of cash flows for the month ended May 31st, 2007. We have cash flows from operating activities. Cash received from revenue transactions of $750. Cash paid for expenses are 50. So we have net cash provided by operating activities of $700. Cash flows from investing activities. Purchase of office equipment of $2,500. Purchase of truck $2,000. Collection for sale of repair parts of $75. Payment for repair parts are $150. We have net cash used by investing activities of $4,575. In cash flows from financing activities, we have investment by owners of 8,000. Increase in cash per month is 4,125. Cash balance of remaining cash balance at May 31, 2007. Operating activities include the cash effects of revenue and expense transactions. In investing activities, these include the cash effects of purchasing and selling assets. In financing activities, it includes the cash effects of transactions with the owners and creditors. The remaining ending balances will appear on balance sheet. Now let's prepare the balance sheet for Aviva's Care Service Company for May 31st, 2007. Aviva Care Service Company balance sheet of May 31, 2007. We have assets, liabilities and owner equity. In assets we have cash, accounts receivable, tools and equipment, track total assets of 21,850. On the other side, we have liabilities as note payables of 13,000, accounts payable of $150. And owner's equity, we have capital stock and retained earnings. The total liabilities and equities are equal to 21,850, and the accounting equation equals. To explain the important relationships among the statement of financial position, income statement, and the statement of cash flows, and how these statements relate to each other. Relationships among financial statements. Time. Date at beginning of the period. Date at the end of the period. Income statement and statement of cash flows. Forms of business organizations. We have three types of business organizations. Number one is sole proprietorship, number two is partnerships, number three is corporations. Forms of business organization. Most business organizations are organized as a sole proprietorship, a partnership, or a corporation. What is sole proprietorship? It is unincorporated business owned by a single person. It is separated from the other affairs of its owners. It is common for small retail stores, firms, service business, and professional practices like in law, medicine, and accounting. Partnership. Partnership is unincorporated business owned by two or more persons agree to act as partners or co-owners. It is widely used for small businesses. Corporation. Corporation is a type of business organization that is recognized under the law as an entity separate from its owners. GAAP can be applied to the financial statements of all three forms of organization. Here are characteristics for business organizations: sole proprietorship, partnership, and corporation. The owner of sole proprietorship is only one. Life of organization limited by the owner's choice or death. Owner and business entity are not regarded as separate in sole proprietorship. Business entity is separated from other affairs of owner in sole proprietorship. Separate taxable entity from owner is not done in sole proprietorship. In partnership, partners are mainly two or more owners, limited by the owner's choice or death. Owners and businessee are not regarded as separate. Business entity is separated from other affairs of owners. Partnership agreement is helpful, may be divided among partners. Partners are personally liable, can sell all or a portion of partnership interest. In corporations, stockholders generally are many owners. Indefinite separate entity from owners. Business entity is separated from other affairs of owner. Articles are of corporation generally requires as the ease of formation. Board of directors are the management level. Stockholders are not personally liable, can easily transfer or sell all or a portion of stock. Reporting ownership equity in the statement of financial position. In sole proprietorship, owner's equity. Partnership. In partnership, it has uh, Aluma capital, Kebida capital, total partners equity. Corporations, owner's equity, capital stock, retained earnings, total stockholders equity. And we are done with chapter number 2. The third one is the accounting cycle, capturing economic events. The role of accounting records establishes accountability for assets and transactions, keep track of routine business activities, obtains detailed information about a particular transaction, evaluates efficiency and performance within company, maintains evidence of company's business activities. The ledgers. What are ledgers? Accounts are individual records showing increases and decreases. The entire group of accounts is kept together in an accounting record called a ledger. We have cash account, accounts payable, capital, stock. The use of accounts. Increases are recorded on the side of the T account and decreases are recorded on the other side. In T account we have title of account, and left it is the debit side and on right it is the credit side. Let's see how debits and credits are recorded in the cash account for JJ's lawn care service. Debit and credit entries. Receipts are in cash account. Receipts are on the debit side and payments are on the credit side, and the remaining balance is the difference between the debit and the credit entries in the account. Debit and credit rules. Debits and credits affect accounts as follows. Assets is equal to liabilities plus owner's equity. In assets, uh, assets are debited for increase and credited for decrease, where in liabilities it is debited as decrease and credited as increase. In equity, debit for decrease and credit for increase. Double entry accounting, the equality of debits and credits. In the double entry accounting system, every transaction is recorded by equal dollar amounts of debits and credits. Assets are debit balances, liabilities plus owner equities are credit balances. Let's record selected transactions for JJ's lawn care service in the accounts. At my one, Jill Jones and her family invested $8,000 in JJ's lawn care service and received 800 shares of stock. Will cash increase or decrease? Will capital stock increase or decrease? So cash increases with 8,000 will be debited, while capital stock increases by 8,000 will be credited. Jill Jones and her family on May 1 invested $8,000 in care service and received 800 shares of stock. At May 2, judges purchased a riding lawn mower for $2,500 at cash. So what will be its entry? Judges purchased a riding lawn mower for 2,500 cash, so cash decreases with $2,500 will be credited, and tools and equipment increases by $2,500 will be debited. At my ad, JJ's purchased a truck with by $15,000. JJ's paid $2,000 down in cash and issued a note payable for remaining $13,000. So truck is increases with $15,000 will come debit, and cash decreases by 2,000 will be credit. Note payable increases by 13,000 will be also credited. My 11J purchased some repair parts for $300 on accounts. Tools and equipment increases by $300 debit. Accounts payable increases by $300 credit. JJ sold half of the repair parts to ABC Lawns for $150, a price equal to JJ's cost. ABC Lawns agrees to pay JJ's within 30 days. Will tools and equipment increase or decrease? Will accounts receivable increase or decrease? Tools and equipment decreases by $150. Credit accounts receivable increases by $150 will be debit. Overview of the accounting cycle. Here are the steps of the accounting cycle. Number 1. Analyze transactions based on source documents. Number 2. Journalize. Number 3. Post. Number 4. Prepare unadjusted trial balance. Number 5. Adjust entries. Number 6. Prepare adjusted trial balance. Number 7. Prepare financial statements. Number 8. Close. Number 9. Prepare post-closing trial balances. Steps in processing transactions. As accounting equation states, assets is equal to liabilities plus equities. Step 1. Examine resource document and analyze transaction. Step 2. Record transactions in a journal. Step 3. Post the journal information to a ledger. Step 4. Prepare unadjusted trial balance. The journal. In an accounting system, transactions are initially recorded in the journal. General journal. In general journal, we have format of date, account titles and explanation, and debit and credit side. Recording transactions, also called original book of entry. The process of recording the transactions is called journalizing. An example shows follows. Step 2. Recording transactions. Step 2 and 3. Enter the month in column 1 on the first line of the journal entry and the day in column 2. Note that entries are recorded in chronological order mean by date. Step 4. Enter the titles of accounts debited. Account titles are taken from the chart of accounts and are aligned with the left margin of account titles and explanation column. Accounts to be debited are always entered before accounts being credited. Step 5. Enter the debit amount in the debit column on the same line as the accounts to be debited. Step 6. Enter the titles of accounts credited. Account titles are intended from the left margin of the account titles and explanation column to distinguish them from debits. Step number 7. Enter the credit amount in the credit column on the same line as the accounts to be credited. Step number 8. Write a brief explanation of the transaction on the line below the entry. Step 9. Skip a line between each journal entry for clarity. Posting journal entries to the ledger accounts. It involves copying information from the journal to the ledger accounts. Posting entries. Entries are then posted from the journal into the general ledger on a transaction by transaction basis. First the debit, then the credit. Posting entries. Step 1. Identify the ledger account that was debited in the journal entry and find it in the general ledger. Example. First entry on January 1 had a debit to the cash account for $30,000. Step 2. Enter the date of the journal entry in this ledger account on the right side. Step 3. Enter the amount debited from the journal entry into the debit column of the ledger accounts. Step 4. Enter the source of the debit in the PR min post reference column. The letter G indicates the entry came from the general journal. Step 5. Compute and enter the account's new balance in the balance column. Remember, a debit balance would be increased by a debit and decreased by a credit. Step 6. Finally, enter the ledger account number uh, in the post reference column of the journal entry. Posting journal entries to the ledger accounts. Let's see what the cash account looks like after posting the cash portion of this transaction for JJ's lawn care service. This ledger format is referred to as a running balance mean as opposed to simple T accounts. Formatting conventions. Generally, dollar signs and RS signs are not used in the journals or ledgers. Rounding. Round numbers in financial statements to the nearest dollars are being used.